Hi, I'm George Pino, the CEO of Commercial Brokers International. I just realized, we just had St. Patrick's Day, and more importantly, that means that the first quarter of this year is about to end. So, as I sit back, I want to kind of look at what has transpired in this quarter, what we might be able to expect coming up in the year, and where we can look to see things going in commercial real estate for the remainder of the year. Now, we've all heard a lot about the retail Armageddon, that the retail-driven businesses are all going out of business due to online sales and the changing landscape with different competition from either delivery services for food to Amazon to even supermarkets getting involved. The interesting part is I don't really see that happening, especially here in Los Angeles. Los Angeles tends to be a pretty dense urban neighborhood and area that really requires retail. And in fact, a lot of areas in certain submarkets, there is what we call, just out today, there was an article about how downtown Los Angeles, there's a food desert, meaning there aren't enough places to eat. So, I don't really foresee that happening so much in the Los Angeles submarket, but as we look toward investments outside of the community and perhaps in tertiary markets, out of state or even further east in California, that might be of a little bit of concern. So one of the other sectors of commercial real estate that has gotten a lot of interest lately has been office space, and there's been a lot of investment coming in and institutional investors purchasing Class A offices and or repositioning properties for Class A or creative type office space. I really don't see that changing much. Now, we have seen a little bit of a flattening in rental rates and a little bit of pushback in certain submarkets, such as in Silicon Beach and parts of the west side, but that flattening has pretty much flattened out. And I do see that for the coming future that it'll probably remain relatively stable and then start increasing a little bit at the end of the year, as demand always seems to outpace what delivery is coming on board. Let's talk about the darling of commercial real estate, and that's the multifamily market. And why I say that is there's been a lot of talk toward commercial real estate, and especially in multifamily in Los Angeles. Specifically that there is a shortage for housing in Los Angeles for the amount of people that are moving into the area, and more importantly, a shortage of affordable housing in Los Angeles. With construction costs on the rise and difficulties in building, and perhaps even some of the changes that the LA Housing is putting in place for rent-controlled apartments that are being converted into condos, I don't see this changing. And in fact, it's a simple economic law of supply and demand. If the demand remains stable or doesn't change much or increase much, but the demand has increased that much more, then you're going to see rise in rents and or favorability. So you see a lot of investors really looking toward those markets and really wanting to invest within the multifamily market. In fact, in certain submarkets, multifamily has been outpacing performance of any other asset class. So one of the submarkets that I wanted to talk about a little bit more is the downtown LA submarket. It's gotten a lot of attention lately with a lot of growth, and in fact, one of the zip codes, the 90014 zip code, was just recently named as the most gentrified neighborhood in the United States. They base that upon growth of income as well as property values. So that says a lot for the changing landscape of the downtown LA submarket. More importantly, though, we start looking at what's happened in this last quarter, and I start seeing, retail, actually the occupancy rates have gone up in the downtown Los Angeles submarket. So has office vacancy rates. They've also gone up. What has, of course, been on fire has been the multifamily market. They had over 1,600 units brought online, new units brought online for rent in the downtown submarket, and they actually saw a decrease in the vacancy rates. What's interesting, however, is that we're looking at a pretty large differential between vacancy rates in the downtown LA submarket versus vacancy rates in the West Los Angeles submarket. For instance, we're seeing vacancy rates that are in the 3-4% for retail in the West LA submarket, we're seeing them in the 3 to 5% vacancy rates in the office submarkets. Meanwhile, in downtown LA, you're seeing vacancy rates that are as high as 17% in office and close to about 12, 13% in retail. And multifamily at about 10%. So even though they're doing well, it's still not doing as well as any other submarket within the Los Angeles basin. So something to keep our eye on, see what's happening, see what is needed, and see how they cope with that. So the last thing I'd like to talk about that seems to be on everybody's mind is interest rates. And this last quarter we saw a little bit of an increase in interest rates, and we expect that to continue throughout the year as the Feds raise interest rates as well. Now, what does that mean toward commercial real estate, or more importantly toward investing in commercial real estate? Most economists believe that the commercial real estate market can withstand about 150 basis points or 1.5% increase in the interest rates before they start seeing some pushback and price reductions across the board, because ultimately a lot of the investments that are being made in commercial real estate are being made by either institutions or family offices or investors that are pretty astute, and they want to look at other alternatives for their investment dollars. So if they can get a better investment going through bonds with less risk, then they're going to push their money that way, which leaves less capital for investment. Again, laws of supply and demand take over. If there's less demand, prices are going to have to come down. Overall, though, with 1.5% increase in the interest rates, we are going to see, I think, if it stays at that, I don't think it's going to affect the commercial real estate market that much. At about a 2.5% increase, that's where I start seeing a little bit more of a pushback, and part of it is going to be based upon also the cost of the debt to purchase the properties. So that's my 2018 first quarter outlook and what I believe we can expect for the rest of the year. So please stay tuned, and as we update that and see how my predictions hold up in the next quarter. Also, as always, should you have any questions or would like any advice on any of your investments, please feel free to reach out to me at any of the media that's below in our contact information. Thank you.